AI stocks have had a phenomenal rise in 2023. The shining beacon of this sector, Nvidia, just hit $2 trillion in valuation, which is more than the GDP of Canada. If this is giving you massive FOMO, I have some good news. The growth in this sector is expected to continue with an annual compounded growth rate or CAGR of 37.4% from now to 2030. To that end, I researched hundreds of AI stocks to identify ones with hypergrowth potential. To put some structure into the evaluation process, I used the gold rush from the late 1800s as an analogy. In the gold rush, there were people that made the tools, people that designed the tools, and people that used the tools. So I categorized the companies from my research into these three buckets and identified ETFs that specialized in companies in each of those buckets. Through this exercise, I identified 4 ETFs with hypergrowth potential. These ETFs have consistently outperformed the S&P 500 index and provide exposure to every part of the AI ecosystem. I'm going to evaluate these ETFs in terms of their portfolio holdings, historical performance, valuation, expense ratio, and beta. If you are not familiar with any of these terms, I'll explain them as we go along. The first fund on the list is the VanEck Semiconductor ETF, or ticker symbol SMH. This ETF provides exposure to companies that design and manufacture semiconductor chips with a tilt towards the manufacturing side. These chips act as the brains to numerous devices that we rely on today, like our smartphones, calculators, computers, and much more. As technology continues to improve and expand, these chips will invariably be in demand to help power new devices. The fund tracks the performance of the 25 largest US-listed companies that produce semiconductors. The top 15 holdings contain Nvidia, TSMC, ASML, Qualcomm, and Intel. Nvidia specializes in making GPUs, which stands for Graphics Processing Unit. This is a type of chip that is good for graphics applications like video games, but it is especially potent at running AI models. Microsoft and Meta are buying up chips from Nvidia at breakneck speed. Microsoft is buying to develop its in-house AI models, and Meta is doing the same by spending billions to buy 350,000 units of Nvidia's H100 chips in its efforts to develop the next generation of its AI. Beneath all this fanfare are 2 lesser-known but equally important companies, and those are TSMC and ASML. TSMC, which stands for Taiwan Semiconductor Manufacturing Company, and ASML are the leading manufacturers of semiconductor chips. They convert silicon, which is pretty much just sand, into silicon chips like this one. So companies like Microsoft and Nvidia don't actually manufacture their own chips. Instead, they outsource it. For example, Apple outsources the manufacturing of its M-series chips to TSMC. By doing this, Apple can focus on designing the hardware and software, while TSMC and ASML can focus on the physics of shrinking the chips. Their most recent development is the 3nm chip process. With this groundwork laid out, let's see how the fund performs. Using the S&P 500 as a benchmark, we can see that SMH outperformed it. The year-to-date return is 20.3%. The 1-year is 77.6%, and the 5-year is 33.1%. If you invested $10,000 5 years ago, it would be worth just under $42,000 today. The same amount invested in the S&P 500 index would return just under $20,000. The next metric to evaluate is the expense ratio. The expense ratio is how much you would pay an ETF per year expressed as a percent of your investments. SMH has an expense ratio of 0.35%, which means that for every $10,000 invested, $35 is paid to the fund managers as fees. This expense ratio is on the high end. For instance, VOO, which tracks the S&P 500 index, has an expense ratio of 0.03%, which is literally a tenth of SMH's cost. But my research of ETFs in this space revealed an expense ratio trend on the higher end. Nevertheless, this is an important metric for you to consider. Do the returns of the funds outweigh their costs? Food for thought. To assess the valuation of the fund, we look at the price to earnings ratio. This metric shows whether the price at which the ETF is trading is overvalued or undervalued and can reveal how the ETF's valuation compares to its industry group or a benchmark like the S&P 500 index. SMH has a PE ratio of 20.35, which is on the high end. The ETF is trading at approximately 20 times the earnings of the underlying stocks. But an ETF like VOO, which tracks the S&P 500, also has a similar PE ratio at 20.1. The takeaway here is that the market is not placing an abnormally higher valuation on the stocks underlying this ETF. The final metric to consider is beta. Beta is a concept that measures the expected move in a stock relative to movements in the overall market. A beta greater than 1 suggests that the stock is more volatile than the broader market, and a beta less than 1 indicates a stock with lower volatility. Beta can also be negative, which means that the stock will move in the opposite direction to the market. By definition, the market, which VOO tracks via the S&P 500 index, has a beta of 1. SMH has a beta of 1.35, which means that when the market moves up by 1 unit, the fund also moves up by 1.35 units. If the market goes down, the fund follows accordingly in the same ratio. The second fund on the list is the iShares Semiconductors ETF, or ticker symbol SOXX. This ETF also provides exposure to companies that design and manufacture semiconductor chips. But the key difference compared to SMH is the weighting of the portfolio holdings. Looking at the portfolio overlap, the two funds have approximately 80% overlap in companies. But SOXX is underweight in companies like Nvidia, TSMC, and ASML compared to SMH. This means that SMH is focused towards the manufacturing end of the spectrum and SOXX towards the design end. On that note, SOXX contains companies like AMD, Broadcom, Qualcomm, and Intel, which have deep roots in designing chips for the upcoming wave of AI products. In Q4 of 2023, Qualcomm announced new microprocessors that rivaled those from Apple, Intel, and AMD. Having said that, AMD is no slouch either. It's fighting back against its main rival Nvidia by announcing new AI chips that go toe-to-toe against the best from Nvidia. This is just the beginning of accelerated AI hardware, and growth-oriented investors will benefit from owning this ETF. With this groundwork laid out, let's see how the fund performs. To begin, the fund outperformed the S&P 500 over the past many years. The year-to-date return is 11.6%, the 1 year is 59.7%, and the 5 year is 29.4%. If you invested $10,000 5 years ago, it would be worth just over $36,000 today. The next metric to evaluate is the expense ratio. The fund has an expense ratio of 0.35%, which means that for every $10,000 invested, $35 is paid to the fund manager as fees. This is identical to SMH. On the valuation front, the fund has a PE ratio of 20.34, which is on the high side. The ETF is trading at approximately 20 times the earnings of the underlying stocks, but it is in line with VOO and SMH. The takeaway here is that the market is not placing an abnormally higher valuation on the stocks underlying this ETF. The final metric to consider is beta. The fund has a beta of 1.34, which means that when the market moves up by 1 unit, the fund also moves up by 1.34 units. If the market goes down, the fund follows accordingly in the same ratio. This is nearly identical to SMH. It's not surprising that SOXX and SMH have similar metrics, given the high overlap in portfolio holdings. The remaining two ETFs, however, buck this trend. The third fund on the list is the iShares US Technology ETF, or ticker symbol IYW. This fund offers exposure to the US tech sector. From an AI perspective, it provides exposure to companies that are at the forefront of developing the next generation of software and related services with AI under the hood. The portfolio holdings of this ETF is dominated by Microsoft, Apple, Nvidia, Meta, and Google. The concentration of these companies is far more than what you would find in a more balanced fund like VGT. As such, it should be complemented with other ETFs on this list or ETFs in other sectors. But this concentration has an upside. These companies are at the forefront of AI transformation and will accordingly give you outsized returns. For example, Meta is fundamentally transforming itself into an AI-first company. Google is embedding generative AI into all of its products. Very soon, Gmail and Chrome might look and behave quite differently. It might also fundamentally transform the advertising space. With cutting-edge developments like Sora from OpenAI, every ad can be custom created for a specific user. With this groundwork laid out, let's see how this fund performs. To begin, the fund outperformed the S&P 500 index over the past many years. The year-to-date return is 7.8%, the 1-year is 60.5%, and the 5-year is 24.2%. If you invested $10,000 5 years ago, it would be worth just under $30,000 today. The next metric to evaluate is the expense ratio. The fund has an expense ratio of 0.4%, which means that for every $10,000 invested, $40 is paid to the fund manager as fees. This is slightly higher than SMH and SOXX. On the valuation front, the fund has a PE ratio of 26.8, which is on the high side. The ETF is trading at approximately 27 times the earnings of the underlying stocks. This is higher than VOO and the previous two ETFs. Pure tech stocks have historically been valued at high multiples. The market is clearly valuing the AI initiatives of these companies through the same lens. Only time will tell if this valuation is justified. From an investment perspective, this metric should inform the weighting of this fund in your investment portfolio. The final metric to consider is beta. The fund has a beta of 1.15, which means that when the market moves up by 1 unit, the fund also moves up by 1.15 units. If the market goes down, the fund follows accordingly by the same ratio. Owning this ETF will result in less volatility compared to the previous two ETFs. The fourth fund on the list is the Invesco QQQ Trust, or ticker symbol QQQ. This ETF follows the NASDAQ 100 index. This index comprises the 100 largest non-financial companies traded on the NASDAQ, and it has historically beaten the S&P 500 index. After considerable research, I chose this particular ETF because it provides exposure to a broad set of companies that will benefit from the adoption of AI into their products and services. The fund contains companies like Tesla, Costco, Netflix, Pepsi, and others that can transform the way they do business by adopting AI. For example, Tesla is developing full self-driving. Netflix leverages AI to personalize recommendations and enhance the streaming experience for its subscribers. And Costco can use AI to mine the treasure trove of member shopping data. With this groundwork laid out, let's see how the fund performs. The fund has clearly outperformed the S&P 500 over the past many years. The year-to-date return is 6.6%. The 1-year is 50.6% and the 5-year is 21.1%. If you invested $10,000 5 years ago, it would be worth just over $26,000 today. The next metric to evaluate is the expense ratio. The fund has an expense ratio of 0.2%, which means that for every $10,000 invested, $20 is paid to the fund manager as fees. This is the lowest of the 4 ETFs on the list. On the valuation front, the fund has a PE ratio of 22.7, which is on the high side. The ETF is trading at approximately 23 times the earnings of the underlying stocks. This is higher than VOO, SMH, and SOXX. but it's lower than IYW due to the tempering effects of the stocks in its portfolio holdings. The final metric to consider is beta. The fund has a beta of 1.11, which means that when the market moves up by 1 unit, the fund also moves up by 1.11 units. If the market goes down, the fund follows accordingly by the same ratio. This ETF has the lowest volatility on the list. While I think these 4 ETFs are a complete set for AI investing, it doesn't absolve you from diversifying your portfolio into other sectors like healthcare. Healthcare will see tremendous advances due to AI. For that, I would ask you to consider ETFs like the Global X Robotics and Artificial Intelligence ETF and the iShares Robotics and Artificial Intelligence Multi-Sector ETF. If you found this video useful, please give it a like and subscribe to the channel. I'll see you in the next video.